such an asshole!
Hey, all, the old captain here. We are finally catching up. Had to drive across the country, so thank you for being patient with me. I finally could get to some of my clients here today. We're on vacation in South Dakota, the west part, because there's nothing else on any other parts of South Dakota. So anyway, so if you have any questions, you go to Asshole Consulting. I provided this client a discount because I think this will be of benefit to other people as well, and that is how to get your money to work for you. So let me read his request, and I'll go ahead and consult my notes. Apologize for doing it this way. It's the only way I can do it in the field. Hello. I've been watching your videos for almost a year, and I enjoy them. So I'm 21 years old, recently graduated from college. I'm an electrical engineer making a good salary. Awesome. You didn't major in English? I don't have any debt because thankfully my parents pay for my tuition, while I also pay for my college housing with summer jobs and internships. After talking with some of my friends briefly about managing money, one of them talked about letting my money work for me by investing in stocks. I don't really know anything about finance, but I don't really have the desires to spend money because I don't have expensive hobbies or habits, so it mostly just sits in the bank and goes into my retirement. I feel like 21 years old may be too young to be putting most of my money in retirement like a 401k in the IRA. I have a friend who has made thousands from investing in the stocks, well, he's lucky now, in the short term, because he keeps most of his money in stocks than in the bank by doing it himself. So what I'm wondering is what I can do to make my money that is in the bank work for me apart from the money I put in retirement so it doesn't just sit there. Should I leave it up to some investment firm or learn about economics first and do it myself? What other options are there? Keep in mind, I really don't know anything about finance. Thanks, Kim. All right, well, thank you, Kim. So let me consult my notes here. Oh, there it goes. Come on. There we are. Okay, so let me answer some very important questions first before I go into the economics lesson here so everybody understands. First, if you don't have the time to learn about investing in stocks and investing in retirement planning, don't just wing it by yourself. It takes a little bit to learn. You got to learn what you're doing. You got to learn how to read financial statements, the concept of price to earnings ratios, dividend yields, stuff like that. And it's kind of like, are you your own dentist? Are you your own doctor? Well, if you're not, then stop it. Now, this does not mean, however, I recommend investment professionals. Investment professionals are scumbags. Last statistics I saw is only 80% of the investment professionals can actually beat indexed funds. So the logic is, without doing any research, without having to piss away 2 years of your life in self-study, you could simply invest in the index, like an S&P 500 index fund at Vanguard, and you will beat 80% of those fucking cocksuckers over at Wall Street. So that's the quick and easy way to do it, and that's the way I would recommend it. This is the way Warren Buffett recommends it, is if you don't have the time and you don't want to spend the money on some flashy suit-wearing con artist, you'll want to go with kind of index funds or ETFs. Those are another kind of variation of an index fund. And now the latest evolution in financial do-it-yourself investment planning are these robo-advisors like Betterment and stuff like that. And I have a thing on my website. You could click on Betterment. And what that does is it says, okay, we're already going to do index funds because we know the professionals can't beat that, or they typically don't. But then the issue is, okay, what's the allocation? What percent are in stocks? What percent are in bonds? What percent is cash? Because that all depends on how old you are and how close you are to retirement, when you want to retire. So you plug in these variables, and an algorithm, a robo-advisor, calculates. It's not a human. It's just, okay, we expect you to die around here, and this is how much money you need, and there's a ballpark figure for you to go with. So you don't pay some sleazeball over at, whatever, Goldman Sachs or Wells Fargo to basically take your money and do nothing with it. So that's kind of the quick and dirty on investing. But then if you like to invest, I'll have some explanations here. Now, getting your money to work for you in the stock market is going to prove problematic, and that is the reason is because the stock market's in general overvalued. And when you say you want your money to work for you, that means you want to make profits. Okay, and so what we got to do is we got to talk about the differences. This is one of the most, I'm not saying this is the most important. Your mom would say, this is the greatest book ever, you have to read it. And then after one or two times of those, you got suckered into reading a book in summer vacation. Instead of being out and played, you're indoors reading like you were going to do in school anyway, and these books suck. No, this is a very important lesson everybody has to learn. And that is the difference between capital gains and income. Okay, profits. That's the thing. All right, so capital gains is just the change in the price of your investment. And this is where everybody focuses on. I invested in a stock at 10, it went up to 20. I made $10. Yeah. And they think that this is investing. That's not investing. Why did the stock go up $10? Well, in theory, you would think that profits doubled. Because stocks just don't go up in value for shits and giggles. They don't just go up in value for no reason. There has to be a reason why a stock's value would double, and that's presumably because the profits that this company was going to generate would double. That's how it should work in the real world. Right? It doesn't because of two major things that are screwing with stock prices right now. You have retirement plans like the IRAs and the 401ks you mentioned that have been in existence in one form or another since 1978. And then you also have central banking policy, quantitative easing specifically, that has also tinkered with stock prices regardless of the underlying profits that these stocks generate. And what they have done is they have disconnected or decoupled is the word they use, where stock prices no longer have anything to do with the underlying profitability of the firm, because why the fuck would it? And the reason why is that since 1978, especially the baby boomers, but now increasingly so the Gen Xers, is we've had 401ks and IRAs. The government, in its infinite wisdom, decided to say, let's give you a tax break if you invest in stocks and bonds for retirement. Never mind, in the olden days it would be cattle, or you'd have an entrepreneurial shop. We just decided the stock market, yes, stocks and bonds, there you go. So the market since then has been flooded with trillions of dollars that would never have gone into the stock market anyway, because people are paid basically a tax benefit, a tax deduction, to go ahead and do it. So people, and you see this on their automatic withdrawal, they just invest. They're not even clicking a button. It just, well, I just tell my HR lady, go ahead, buy and hold. That's what I do. No, it's gone. You don't even know. You don't even miss it. It's a way to invest. They don't even realize, they don't even ask the question, is my monthly contribution of $400 a month or $500 a month buying stocks at a good price? They don't care because they're concerned about capital gains. Now, the other thing that has driven stock prices up beyond what the earnings have warranted is central banking policy. And so what central banks have done is that we've printed off money with quantitative easing, but also we have lowered interest rates a lot. And the interest rates are so low now that corporations are borrowing at very low interest rates and buying back their stocks. And as of recent, I'd have to look up the figures. I think there's been like 1.2, maybe even $1.5 trillion worth of buybacks. Also, with interest rates so low, people can borrow in the house, and then they can go ahead. They have all this extra money because their mortgages are lower, and that money throws into the stock market. So not invariably all the money, but invariably some of this money, be it printed off or lent out at very low interest rates, finds itself into the stock market, driving up stock prices. So now there is, again, this decoupling. Stock prices have nothing to do with earnings anymore. It has to do with how much money is flooding the market, and I would say mindless money. This isn't investor money who's saying, hey, what kind of rate of return am I getting? So everyone is very excited. We're all happy because stocks go up in price. When you have to ask the philosophical underlying question, why do you invest in a stock? Why do you invest in a business? Because you hope the stock goes up? Let's take away a stock for it. Let's just say it's a private business. I say, hey, Kim, you want to invest in Cleary Corp? And I'd say, I need $500,000 for you to, and you get 50% of the company. $500,000, 50%. So you would say, oh, well, can I sell my shares later on for more than $500,000? No, you would logically say, whoa, hold on, Aaron. Before I give you $500,000 of my money and own 50% of this wonderful corporation you have, what kind of profits are you generating? Because I would be entitled to half those profits. That's the only thing that really gives your shares, your ownership of the company, any kind of value at all. Because if you do some mathematical calculations, you say, I'm going to give you $500,000, and the money that it's going to generate in terms of profit better be worth more than that $500,000, in addition to accounting for the lost time I could have been investing in someone else, opportunity costs, and the risk of the business as well. Plus, I may have other alternative investments that generate a higher rate of return. So that is the difference between capital gains and profit or income. You never invest for capital gains. There's no such thing as capital gains. I know there is a thing called capital gains because you see it every day. Stock price has been going up. But what you really invest for, if you're going to invest and you want your money to work for you, that means your income, your investment, the money you invested, generates a profit every month, quarter, or year. and then you get that paid in the form of a dividend, or you take some kind of you get a dividend, you get an income interest off of bonds, you get dividends from stocks, mutual funds, you get dividends, but it's all the same thing. What kind of profit, what kind of income is this property generating? And you could even use it as rental property as a perfect example. There's no difference between a duplex that you rent out and a stock. You invest in a duplex, why? Because you think you might be able to sell it for more later? That's stupid. You invest in a duplex because of the rental income, because every month you get that check, because otherwise no investments have any value if there's no income. Think Beanie Babies, okay? That's it. Well, you're maybe a little bit too young to remember that. So that is the problem that we're facing right now with the stock market, is there's so much money from retirement funds and central bank money and low interest rate money that the stock market has gone up to such prices, such heights, that the income, the underlying profits that these stocks generate just isn't worth it. And I know a lot of people like to complain about the interest rates. I only make 1% or 2% on my savings account at the bank. Well, stocks are no different. You're making about 2% right now if you look at dividends, which is the only income you ever get from a stock. The only reason stocks have value is because of the dividends they pay. And if you look at what's called the dividend yield, if you say, okay, what kind of rate of return could we expect in the past? If you owned a stock, you could expect a dividend yield of about 5%, meaning if you invested $100 in a stock, every year you would get $5. You get a 5% rate of return. That's the historical average. Sometimes it was 12% in the Great Depression. You could make some good money on a stock. 10%, that's a pretty good rate of return. Now, guess what it is? It's 2. It's just like your savings account. You don't even beat inflation by investing in the real purpose for stocks and bonds. So, try to disassociate between capital gains and income. That's a huge. You invest in. If you are going to invest, you invest for income. You do not invest for capital gains. That's called gambling. And you can play the capital gains gambling hall all day. You could go ahead and invest and then hope to God they print off more money and the corporation buys back its stock and it just inflates up, and then, oh look, see, I made money. But you're taking a risk and your money really isn't working for you. So that's the drawbacks of looking at the stock market. Someday the stock market might actually be worth it. But my personal opinion, not now. I would not be looking at it. So what can we invest in where your money works for you? The number one thing I found is entrepreneurship. I wrote a post called "Why I Will Invest in Davis Arini instead of the S&P 500" or something like that. And the reason why is I paid Davis $1,000 to read my book, an audiobook, and then I will generate, I expect, about $60 per month in audiobook sales. And now this does nothing to do with I don't get a tax deduction or anything like that. I don't get benefit from the government, but I lay down $1,000. I give it to Davis. There's my investment. And it is proven. We did batch of pad economics. He recorded that. And that increased my my monthly income by $60 a month on average. It goes like this. Anyway, so let's think about that. You say, oh, $60 a month. Oh, really? $60 a month? That's stupid. Well, 60 times 12 is, what is that? $780? Did I do the math right? 60 times 12. 6 times 12. Oh, hang on. 60 times 12. $720. 600, the two, $720. Yeah. So $720 per year. That's a 72% rate of return. Do you know any stocks that provide a 72% rate of return? Right? Now, admittedly, it's pretty high for, like your average bar. If you go into a business like that, it's not going to provide a 72% rate of return. But what I am finding is that entrepreneurship is providing higher rates of return. Investing in your own personal business, assuming it's profitable, not some stupid fucking hobby like girls in their little fucking horse farm. I run a horse farm. I like animals. None of that bullshit. But you, being an electrical engineer, you probably have some savvy ideas about some things that might be profitable. So that is, and not only are you going to find higher rates of return there, it's lower risk because it's you. It's you. You're investing in yourself. Okay? And another upside of entrepreneurship is that someday it could replace your own income. And on top of it, if your boss gets lippy, you always have a plan B. There's so many benefits beyond financial that come with entrepreneurship. That is the number one thing I'd be recommending. Now, I don't, you may not have an idea today or tomorrow or even next year. It may take a while. And you'll probably come up with a bunch of ideas that will fail. All you need is one. You just need one. So I would be looking at entrepreneurship. Now, please, for the love of God, you don't want to invest with your skeezy buddy back from college. Yeah, he's got this idea and all he needs is my life savings so he cash. No. Read Bachelor Pad Economics. You never take on a business partner. It's all you. You never take on a business partner, okay? You invest, you come up with an idea, you shut the fuck up about it, you don't tell nobody. If you got a great idea, I got a bunch of great ideas all right up here. Ain't telling fucking nobody nothing of it because I want the money. I don't care how bored you are, how cool it is to go into business with your best friend. I've never known a business partnership to work out. You are the solo entrepreneur, right? And find a way to do it. So, but just don't, take too risky of investment. Don't cash out your 401k. Make sure it's something good that you can do. Second thing, pay off your debts. I know you don't have any, but for other listeners, paying off your debts is the only truly risk-free investment. A lot of people say, well, investing in government bonds is risk-free. Yeah, tell that to the Argentinians, the Cypriots, the Greeks. Who else got totally fucked over? The Russians, the Koreans. Just because it's the government doesn't mean it's risk-free, right? But what is risk-free is you. If you owe somebody money at 4%, say your mortgage, and you pay it off, there is no risk because you're the one with all the risk, right? So you get a 4% rate of return, risk-free. That beats your savings account. That beats stocks if you're just looking at dividend income. It beats pretty much every standard classical. This is why I wrote an article that we should be allowed, instead of an IRA contribution, any accelerated principal payments up to the same contribution limits should be allowed to be tax deductible. That would really improve Americans' financial situation, and at lower risk than what they're doing investing in the stock market. But I didn't go to Harvard, and I didn't have Goldman Sachs' cock up my ass, so I don't know anything. But regardless, if you have a car loan, credit cards, heck, some credit cards have a rate of return or an interest rate to the bank of 17%. Dude, you can get a 17% rate of return by paying off your credit card. That's great. That's going to beat the market most years. So I would always pay off your debts, even though you don't have any. For younger people, if you got enough money, it might be worth to buy yourself some small little house or maybe a condo that can be rented out. And even though I'm not a big fan of property ownership, if you have the cash just to pay for it and you know you're going to be in a place a long time, you find out you really like this job, you know you're going to be there for 10 years, it might be worth just getting a small little condo, small little something, maybe a small house with some acreage on it, and then you never really have to worry about lodging again. Because even if you don't live there, if you can rent it out, and it brings up a whole bunch of other problems, like finding tenants and all that. But if you do it right, you can eliminate all your future lodging expenses. And that's a huge rate of return right there. So that is your money working for you. These dipshits, but what about the mortgage tax deduction? I need to write off my interest expense. You fucking idiots need to not vote ever again. Just get the fuck out of the gene pool. Please don't breed. Don't even worry about my mortgage interest tax. So pay off your fucking debts. I don't care shit. I don't give a shit about the mortgage tax deduction. So yeah, get a small home, something you could potentially around. Another one, peer-to-peer lending, like Pureform, not Perform, pureform.com and prosper.com. You're lending, there's risk involved, but you can eke out a little couple more interest rates percentages over what you can get in the stock market or the bond market. Again, you could lose your investment. There's no guarantee. All investments have risk, blah, blah. But matter of fact, you're going to lose all your money if you listen to me. There's my legal disclaimer. But that's another option you might want to look to, is peer-to-peer lending. And then finally, I would be looking at increasing your skills. Not necessarily just diversification, like if you want to become a mechanic because it provides you an alternative form of employment. But if you, being an electrical engineer, if there's some other certifications, I don't want to say education because there's such an education bubble. It's like, don't go get your master's in electrical engineering unless you really wanted to. But you would know better than me what certifications are there, what qualifications, what other skill enhancing, but more importantly, wage increasing, hourly wage increasing certifications can you have that will increase the value of your labor. Okay, because that's an investment. Even though you got to go to school, it's an investment of both your time and your money. You probably got to pay for some certification or class or whatever. But if you can increase your wage by 30% by dropping $1,000 or $2 and a couple hours of your time on some kind of certification process, and it's guaranteed, like, oh yeah, this is a really rare one, that is also a wise investment of your time and money. All right, so that's what I'd recommend. So those are kind of the 5 things. We'll review them again. Remember, entrepreneurship, that's my favorite. Paying off your debts, that's another way to get a risk-free rate of return. Buying a small house so that like you have lodging every time and you don't have to worry about your single largest expense in life. Pay off that mortgage early. Never deal with it again. If you're not living in that house, rent it out. Make sure you can rent it out before you buy it, especially with the condos, homeowners associations. Peer-to-peer lending, and then some kind of skills certification that will increase your market wage. Now, how to educate yourself about investing. I have 2 classes. I do not recommend them because I make money on them. I recommend them because I make money on them and they will help you. The one I would recommend over the other would be called the Analysis and Valuation of Stocks. That teaches you how to read financial statements, how to read a balance sheet, income statement, cash flow statement. It also talks about valuation. How do you value a stock? How can you assess whether a stock is worth investing in it or not? And it also, when you learn how to read financial statements, you can learn about your taxes. It's just a darn good skill to have regardless. And that will allow you to look at any kind of investment and say, okay, what are its revenues and expenses? What are its profits? And let's compare what its profits and its income generating potential is versus what kind of price they're asking me to pay for a share of stock or to buy the whole company. The other class I have is Stocks, Bonds, Investing, Oh My. And that's really more of an introductory, what is a 401k, what is an IRA. If you know absolutely nothing about finance and investing, I'd maybe recommend taking that course first. But keep in mind, a lot of it's conventional. This is, I'm going to miss my 401k. What? Central banking? Nah, I don't like that. That's alt-right stuff. Like, if you are slightly savvy as to some problems that might be occurring because of central banking, or maybe there's some problems with the national debt, this might be a little bit too entry level for you, because it really is in the perfect squeaky clean world. We all just invest in our 401ks. Oh my goodness. And then you look at the thing, oh my, I can invest in Charles Schwab. And then you retire and there's no problems. The U.S. won't default on its debts. But yeah, so just take that with a cup of salt, because I'm like, this is how it works in the real world, and I can't tell you how I think it... Or no, this is how it works in the perfect world. I can't tell you how I think it's going to work in the real world, because then I'd be called an evil, misogynist, racist, bigot, homophobe. Actually, I wouldn't. I'd just be called a crazy, right-leaning... You own guns? Gold and silver. Oh, my goodness. Oh, you're one of those guys. Yeah, I'm one of those guys. But you can find those classes online. What else? Otherwise, you don't need to take those classes. They are a bit pricey. Just search the titles, the Analysis and Valuation of Stocks, and the other one, Stock, Bonds, Investing, Oh My. You can take those anywhere online. It doesn't matter where. Sometimes you can get college credit for it, depending on what institution you take it through. But it's offered like 500 different community ed, local nonprofit type places. So, take it wherever it's cheapest. The other thing I would do, if you don't want to drop the money, you could totally educate yourself online. It may not be as organized and outlined. The only real reason you take my class is because I organized it and put it together and very logically and linearly organized it, so it's absolutely 100% digestible by the average, or I shouldn't say average, by the non-financially educated person. So that's why I kind of like it. But you can totally go online. Investopedia has some great tutorials. Just search plenty of people with YouTube videos up, like how to read an income statement. What is a balance sheet? But I would particularly focus on articles written by Robert Schiller. And I would focus your attention towards understanding price to earnings ratios, dividend yields, and not so much price to book. Price to earnings, dividend yield. Yeah, those two things if you're looking at stocks. You want to look at the dividend yield and you want to look at the price to earnings ratios. That right there will give you about 50% of what you know, and then it will be like, oh, wow, okay, you understand that. That would be the jumping point then to organize and structure the rest of your self-education on. So, anyway, hope that helped out. Hope we all learned how to get our money to work for us. And, remember, I'm just a crazy guy who owns silver and gold. I guess I should tell you guys maybe what I have. I just pay off my mortgage. That's all I do. I pay off my mortgage. I don't even have a 401k or an IRA simply because it's not worth. I don't like the investments. I invest most of my stuff back into my own entrepreneurial stuff, like my books or advertising or marketing for that kind of stuff, asshole consulting. I do have some silver and gold. No, I don't have gold. I only have silver. And I have some guns, but not a ton because you don't become one of these gun nuts where you have like six. I know one guy who had 600 guns. That's not an investment. You can't use that for anything. But yeah, those are more insurance plays than anything else. But yeah, that's why I invest in. So hope that helped. Hope that gives you guys some options. And swear to God, please learn to don't invest for capital gains. Invest for income. Best of luck to all of you. Toodles.